think that maximum employment is the maximum level of employment consistent with price stability. In other words, she elegantly ties that together, that price stability is what you can have more control over rather than, you know, all these other factors that enter.
With tariffs, with immigration, with fiscal policy, and with regulatory policy, I would add energy into that, by the way. We need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. This is no different than any set of policy changes at the beginning of the administration. However, December 18 of 2024 at the FOMC press conference, you noted, and I'm paraphrasing, that some Federal Reserve officials began to incorporate preliminary conditional estimates of how fiscal policies might impact the economy into their forecasts. This seems inconsistent, and I sidebarred with the chair to say, okay, did I hear this correctly, his question and sort of your answer? What I heard is that there was a belief that the IRA would not be inflationary, but that tariffs could be. Therefore, suddenly you and others were commenting on tariffs. And
the impact of tariffs and so forth, and they said, again, it hit a 5-year low. And again, I'm getting this from a source. But this sets the market up for higher inflation and more burdensome housing costs to years to come. So Chairman Powell, you know, I'm looking at this monetary whatever policy framework that you guys have put together. Do you think that the way it's structured, and again, I'm trying to understand how you're looking at this in the housing crisis, do you believe it's eroding new rental supply under construction right now, leading to high inflation in future years?
So I think there are two things going on quickly. One is just there's a longer run shortage of housing in the United States, which there's nothing that the Fed can do about. That's not something we can affect.
Well,
there's also, if I may say, in the short run, rates are high, and that's going to weigh on housing activity. But the best thing we can do for the housing market, the absolute...
Let me shift gears, because I want to give you just a little bit of an opportunity to comment on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability, but also higher rates have a significant impact on the housing market, as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Can you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability at the interest rates that is currently set by the Fed?
Sure. So, you know, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. You know, it's been one of the stickiest parts of inflation. I'm happy to say now.
Minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move in monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates, but you know we're at higher levels of interest rates now, so there's significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the.
We're in touch with the other regulators and the parts of the government that work on cyber, as you know, and you know we're in touch with the banks to say, you know, for people to be on the alert for things like that to happen, and also we're on the alert because you know we're a target as well. So you're right to raise it. It's a it's a big issue, and
you feel like you have the resources right now to be prepared for that?
Yes, I mean, I think we do. We spend a lot, and the government generally spends a lot on these things, and but you know, you can never ever be comfortable in this area because you know the bad guys are always getting better. So we need to get better.
Thank you, Chairman. Switching gears, the president and members of his administration have recently called you out, various name calling for certain decisions you've made. I know that some people worry that the president's bullying will impact your decision-making. I know you have worked together.
And we have an open board meeting on Wednesday afternoon, and after I finish my hearing on the Senate side, and I'm very much looking forward to putting this proposal out for comment.
Thank you. In March, the Federal Reserve, together with the FDIC and the OCC, announced that they intend to issue a notice of proposed rulemaking to repeal the 2023 Community Reinvestment Act and replace it with the legacy CRA framework. Nearly 3 months have passed since this announcement. What is the status of this project?
Well, we're going to do what we said we were going to do. It's just a question of execution, and I think you'll see that coming. This would be so Vice Chair Bowman has the job of sequencing these things, and that one's certainly coming.
Do you intend to issue a proposal that will be a clean rescission and replacement of that rulemaking, or are you considering amendments to the legacy rule?
I honestly don't know. We'll come back to you on that.
Okay, so we should know more later this